Economics is a social science closely related to mathematical methods. When making predictions and interpretations related to economics, support is generally sought from sciences such as statistics and mathematics. Occasionally, assistance is also obtained from social sciences, particularly in the dimension of behavioral economics, involving human behaviors from fields like social psychology. Both the global and commodity markets play a role in understanding what is happening and what developments are taking place. In the upcoming week, I will share our predictions and interpretations with you. Let's get started. On Friday night, a piece of news arrived in the last minutes. After 1 a.m., after the markets had closed, or even a few minutes before closing, let's say, Moody's shifted its outlook on America from stable to negative, indicating a preparation for a potential downgrade. As you already know, the other three major rating agencies, S&P and Fitch, had taken similar actions. Now, Moody's is heading in the same direction. In other words, all three major agencies are observing the United States negatively. The main reason cited here is the financial troubles being considered on America's agenda, with data indicating that the budget deficit will increase. What we are trying to convey here is such a significant problem that the world is no longer accepting American bonds. The trouble arising from these bonds, as interest rates rise systematically, is causing America to become unable to repay its debt. This difficulty will inevitably continue to impact America's credit rating, leading to an unavoidable conclusion. However, even though ratings agencies may be seen as reliable or unreliable to a certain extent, the outcome will inevitably lean towards the downside. Consider the situation from an interest rate perspective. In a high-interest environment, no matter what economic scenario you try to paint, it won't work. Following Biden, his officials at the U.S. Treasury have made statements like, "We don't agree, they can't see the realities," suggesting a divergence in views. I had heard persistently about the U.S. interest rates last week. I had mentioned that the critical level for American 10-year bonds was 4.48, and as long as it stayed above that, the direction would be upward. That's exactly what happened last week. It hovered around 4.47 and closed at 4.64. Look, that 4.48 is still crucial. As long as it stays above this trend, I am still expecting it to go higher, maybe even reaching 5.1 or 6.15 in the short term. In the long term, it is expected to go much higher. But in the short term, below 4.48, there could be a considerable consolidation period, potentially entering a prolonged sideways movement. This could also be a period of stagnation, much like what happens with gold or silver. The main reasons are insufficient demand and the primary cause of the decline in oil prices being a decrease in global demand. Yes, the era of neoliberal order is over. There has been no such order in this channel for years. I have been trying to explain this since I started. We are transitioning from the neoliberal order to a bipolar, autocratic world, unfortunately dominated by different systems. In the meantime, conflicts and wars in the bipolar world have resulted in increased geopolitical trends, which will also increase interest rates. In the medium to long term, interest rates will not fall, they will only rise. Only during times dominated by recessive waves, the possibilities of interest rates suddenly dropping increase. This happens when the market is negative, and it will only happen then. We will explain it once again. On Thursday, there was a disturbance in the market. American markets even seemed to turn negative about it. Then suddenly, on Friday, it corrected, even exceeding the previous levels. Technically, these are not real corrections. America is causing trouble with its borrowing issues. Look, there was a 30-year bond auction immediately after that. The market got disrupted, and while bond yields were going down, suddenly, they shot up again. Because in the short term, America has some chance of creating demand, but in the medium to long term, it struggles with borrowing, especially for 30-year and 20-year bonds. In that regard, the negative sentiment in them continues to be upward. As you know, most borrowing in America is done through 30-year bond interest rates. As they go up, America's long-term problems in banking, short-term borrowing and eating it up in the long term for profit from the arbitrage, have become difficult. But for a while, the banking system has not been making money. In fact, there was news last Friday that there would be increased assistance from the Dallas Fed president to the banking system. Even as the market was doing well and was very healthy, we saw that the fund allocated for crises in the banking system suddenly grew. On Thursday night, in the data, we actually saw that despite the optimism in the market, it didn't reflect in prices. Yes, it really happened, it didn't reflect in prices. In the Nasdaq chart, there has been a rapid rally lasting for 15,140 days, equivalent to business days. It has become very challenging to predict where it will end because of the speed of this rally. Therefore, from a technical perspective, sometimes macro factors do not align with each other, and during those times, either your medium to long-term position will be very small if it's downward, or if you are trading, you should follow the short-term market and track the technical levels I provide here every week in these videos. The purpose is to follow them. As long as it stays above 15,140, technically it is expected to move upward. These are my predictions. As for the S&P 500, there is a change. Look, the market in the S&P 500 was a bit slower, but it also went up. But now, it has come to a very interesting point. There is a wolf pattern there, and the 44.22 section will be critical. If it cannot move above 44.22, there is a possibility of a reversal around here. The critical closing point is 4,418. Since the news came in the last seconds after the markets closed, the note news from last Friday may not be very important. Perhaps it will affect the interest rate market more in the short term, but regardless, there are still problems with general borrowing. I still see issues in the S&P's overall average, that the average stocks are still not performing. I'll show you something about it shortly. But we are going through a strange year where, in a few remaining companies, 493 out of 500 can still be manipulated. It's a year that will go down in history, a 2023 to be remembered. These price movements will truly be unforgettable, just like in the year 2000. Dow Jones, too, has a bit of a similar situation. It broke upwards a bit, and was taking a bit of a rest. As long as it stays above 3386, there is upward potential, but I am monitoring Dow Jones closely. Above 3386 is positive, below is negative. I will be keeping an eye on Dow Jones this week. I've also taken a look at the ETF of Russell 2000, which is IWM. IWM, look, when we look at the same charts for indices, there is generally a similarity. The strongest one is slowly weakening as we look at it more closely. Since Russell 2000 includes more medium-sized companies, you can see how its performance has lagged. Look, it goes up for 2 or 3 days, then it has been going down for several days. Friday was almost the best day of the year for the Nasdaq, up by 22%, but Russell barely made any gains. It was slightly negative at the last moment. Look at how negative it has been for the last 3 or 4 days. You can also follow IWM there. I analyze it as positive as long as it stays above 168, and negative below. In that regard, the movements there provide more informative insights into the broader economy. If IWM is not participating in the movement, it actually means that the movement may not be sustainable. But if the upward movement continues in IWM, it indicates a more macroscopically healthy trend. Therefore, looking at IWM affects my medium to long-term decisions a bit more. Consider this as a new insight. Let's quickly take a look at stocks. Regarding Apple, there was an analysis report. We remember that in 2015, Apple was trading with a P/E ratio of 14 and a 35% quarterly growth. When we compare its current price with the price back then, Apple should be priced at less than $100. Because now, the P/E ratio is more than double that of the time, in the 30s, and its year-over-year growth is negative at around -7%. Look, the company is not growing, but somehow, it continues to be held up with the cash in hand and share buybacks. You might say, well, we look at our profits. But when there is no fundamental macro structure behind it, when it lacks fundamental analysis, trouble will inevitably come in the medium to long term. It's good to be prepared for that. Speaking of which, on Apple's chart, it broke the falling channel trend as long as it stays above the 180 to 50 cents trend following level. It is going upward, but keep an eye on the 180 to 50 cents level. You can trade upward as long as it stays above. However, be cautious and more attentive around the 188L or even above the 190 region. It will be heavy around these levels, so I recommend being cautious and more careful if you are looking upward on Apple. I don't hold a position in Apple. And there was news about another big company, Tesla. Biden announced his support for unionization in American factories, including Toyota and Tesla. So, Tesla's smooth production is a bit troubled in that sense. Additionally, it's both lowering its prices, and profitability is decreasing. It is trying to dominate the market in the long term, but if you look at Tesla's stock price this week, it was the least performing among the other 6 magnificent companies in the index. The troubles there are growing. At $230, the 200-day moving average is still putting pressure from above. But in the short term, even at $219, it couldn't perform well. As long as it stays below, I can say the direction is downward. As for Nvidia, the trend following level is $464. Its chart is currently quite strange. Yes, it formed a complete head and shoulders pattern, as if it were going to break downwards, but it managed to pass us, moving upward. Technically, $464 is the trend following level. I look at the long-term picture, but I think all markets are manipulated from here. Therefore, my cautious and careful perspective continues. Bitcoin made a strong move this week and moved upward, breaking any resistance. In the short term, there doesn't seem to be any resistance left. However, whether this was a fake breakout or not, we will understand as more news develops. Some say there might be a hidden bull rally. Honestly, I am now looking at it much more cautiously technically. It could continue upward in a bullish trend as long as it stays above $36,100. However, the constant news about ETFs bothers me because it might be creating artificial excitement. Regardless, there has been a cash inflow into Bitcoin, and even though I don't think there is monetary expansion in America, the trouble in the bond market may indirectly create pressure on assets. This could lead to a turning point indirectly, creating a recessive and static trend. Therefore, in this case, we will look at the technicals and make decisions based on that. You know that I am extremely optimistic about Bitcoin in the long term. Maybe the long-term movement has already started. Honestly, it bothers me that the main problem in America hasn't erupted yet. When it does, we will observe Bitcoin's behavior. But if you are determined to own Bitcoin, you can set a stop below $36,100, and it could continue its upward movement. Below that, I will turn negative, I'll be clear about that. Ethereum also made positive movements this week. It surpassed the $2,000 trend following level. However, before reaching the previous peak of $2,146, there was some selling pressure. I am positive above $2,000, and below that I am negative. But if it can't surpass $2,146, there is a possibility that this region could become a peak. Ethereum's positive movement is also attributed to ETF applications, similar to Bitcoin. There might be optimistic statements like, Bitcoin will be approved, and so will Ethereum. But these optimistic statements have a positive impact on the short-term market. However, they are not good in the medium to long term because ETFs are not the right products for these assets. What matters is not the ETFs but the real valuation of these assets. But it is important to be cautious because I don't think ETFs are the right products for these assets. After that, if BlackRock dominates the market, you'll have to deal with BlackRock's manipulations for the rest of your life, just like we saw with gold and silver. I will continue to shed light on your path. Wishing you all very careful, profitable, and wonderful days ahead.